Construction Business and Law Manual for Nevada, Chapter 6, Financial Management Overview. The contractor, as a business owner, is responsible for the financial health of the business. In many cases, business failures are related to financial problems rather than construction problems. Bankruptcy can result in cases where the financial health of the company deteriorates to the extent that funds are not available to pay employees or vendors. While it is not necessary for owners to be accountants, it is important that they have an understanding of some basic principles of financial management. In a small business startup, it is fairly easy for the contractor to handle the company's finances personally. In this scenario, the owner must be aware of timely payments for employees and purchases, and the cash flow from the construction jobs necessary to accommodate these payments. The contractor should also be able to understand, if not prepare, the financial plans and documents necessary to conduct a profitable business and prepare for benefit and tax outlays. As the construction business grows, legal and accounting services will probably be used. Even under these circumstances, the contractor should be able to understand the most important aspects of the documents prepared by the outside professionals. It is important that contractors realize that they are the final responsible parties. To help the contractor accomplish the objective, this chapter will provide a brief overview of sound financial practices, including some basic accounting terms, a basic financial record-keeping system, information about how to identify and understand essential financial reports, information about how the financial reports and ratios relate to the business, progress payments, progress terms and discounts, and management of construction equipment costs. Basic accounting terms. Some of these terms may not be used elsewhere in this chapter, but are included to acquaint the reader with terms related to financial reports and statements used on a regular basis in the business. Accelerated depreciation. One of the two basic methods for allocating the cost of a fixed asset over its useful life. With this method, a greater amount of depreciation expense is calculated in the early years and lower amounts in the later years. Accounting. The procedures for recording, accumulating, and analyzing important information about the financial activities of a business and preparing summary reports of these activities, some of which are called financial statements. Accounts payable. The liability arising from the purchase of goods or services on credit, usually an unsecured claim for payment by vendors. Accounts receivable. Assets from the sale of goods or services on credit. Accumulated depreciation. The total amount of depreciation for a fixed asset that has been charged as an expense over a number of years. Asset. The property that is owned and is used in the business. This includes cash accounts, receivable, money loaned by the business, land, prepaid insurance, equipment, buildings, furniture, fixtures, assets are divided into two types: current assets and fixed assets. Balance sheet. The financial statement that summarizes the assets, liabilities, and owner's equity of a business at a specific moment in time. This shows the company's overall financial position. Break-even point. The point where sales revenues equal the total expenses of the business. At this point, all fixed costs are covered. Budgeting. A process of estimating expenses and income and adopting a profit plan for the coming financial period. Budgeting is also used for estimating assets, liabilities, and cash flow for the forecast level of sales and expenses. Actual performance during a period can be compared against budgeted goals. Cash budget, a type of budget used to compare expected receipts against planned expenses to ensure that there are sufficient funds to meet payroll, accounts payable, and other short-term debts. Cash discount, a percentage off the invoice price in exchange for payment under agreed upon terms or a reduction in the selling price of merchandise. Cash flow, cash coming in, going out during a financial period. The cash flow statement classifies cash flows into three different categories: from operating activities, from investment activities, and from financing activities. Cost of goods sold. Cost of raw materials, direct labor, and factory overhead incurred in producing all the goods manufactured during a period. For a contractor, this might be the cost of the materials for the project added to the cost of building the project. Current asset. The sum total of the company's cash, accounts receivable, inventory, and prepaid expenses. An asset that can be converted into cash within 1 year or one operating cycle. Current liability. The sums of accounts payable and accrued liabilities, income tax payable, and the portion of long-term debt that falls due within the coming year. Depreciation expense. Allocating a fixed asset's cost over the estimated useful life of the asset. For example, if a $10,000 piece of equipment has a useful life of 5 years, its value on the books can be reduced by $2,000 each year. The $2,000 is entered as an expense for each of 5 years. This does not apply to land. Direct costs. Costs directly apply to a particular job. Examples are labor, materials, and subcontractor payments. Financial statement. The generic term used for balance sheet, cash flow statement, and income statement, all three of which present summary financial information about a business. Fixed asset. The shorthand term for the long life, generally 3 years or longer, operating assets used by business, which include land, buildings, machinery, equipment, tools, and vehicles. Fixed costs. Costs that do not change when the workload changes. This includes such items as rent and property insurance. General ledger, an account book in which all final entries of business transactions are recorded under various account classifications. General overhead, general and administrative expenses that are not directly related to project costs. Examples are accounting costs, computer costs, rent, and utilities. Gross margin, profit, equals sales revenue less cost of goods sold for the period. Income statement, the financial statement that summarizes sales, revenue, and expenses for a period and reports profit or loss. Job overhead, overhead costs which apply directly to construction earnings for a particular job. Liabilities, debts or amounts owed to creditors. Liabilities are divided into two kinds, current and long-term. Long-term liability, any obligations or debts due and payable over a long period, normally more than 1 year, and which do not fall into the category of current liabilities. Net income equals sales revenue less all expenses for the period, including any extraordinary gains and losses for the period. Net worth, the remaining interest in assets after deducting liabilities. For example, if a business has total assets of $100,000 and total liabilities of $40,000, then its net worth is $60,000. Net worth is also referred to as owner's equity, stockholders' equity, or partner's equity. Overhead. The portion of the contractor's price is that generally allocated to cover indirect or general administrative expenses in operating the construction business, costs that are attributed to more than one project. Owner's equity. See net worth. Net worth, the remaining interest in assets after deducting liabilities. For example, if a business has total assets of $100,000 and total liabilities of $40,000, then its net worth is $60,000. Net worth is also referred to as owner's equity, stockholders' equity, or partner's equity. Owner's equity, net worth. Points on loans. A one-time charge made is a percentage of the loan. This is a fee the lenders charge for generating the loan and is in addition to the interest rate charged for the loan period. A fuller discussion can be read in the bank loans section near the end of this chapter. Profit. A general term, it may mean gains minus losses, inflows minus outflows, and some other kinds of increases minus decreases. Generally, in business, it means sales revenue minus expenses for a period of time, shown in the income statement as net income. Profit and loss statement. Another name for the income statement, profit and loss statement. Project overhead. See job overhead. Job overhead. Overhead costs, which apply directly to construction earnings for a particular job. Source document. Important original documents and the basis of an accounting system. Includes invoices, both received and sent, cash receipt records, time cards, check stubs, or other documents which are used for accounting journals or entries. Straight line depreciation. The simplest depreciation procedure. It writes off depreciable value of an asset at a uniform rate throughout its usable life. It assumes that the amount of value that is lost is constant year after year. It is widely used by contractors for estimating equipment costs for certain job and equipment cost control for ongoing projects. Variable costs. Construction costs that change according to how much work is available. This includes such items as supplies, overtime pay, and subcontracting costs. Working capital. That amount of current assets that exceeds current liabilities. For example, if a business has current assets of $50,000 and current liabilities of $30,000, then the net working capital is $20,000. Yield. The annual return on an investment, expressed as a percentage. Importance of record-keeping systems. Keeping financial records is probably not what contractors do best. Most likely, they would rather spend time bidding on projects and building them than on financial record keeping. However, accurate and timely financial information is absolutely necessary in order to maintain a successful business. A good financial record-keeping system will enable the contractor to monitor the success or failure of the business, provide the information needed to prepare accurate estimates, determine whether to bid on a job, obtain banking financing, obtain other sources of capital, prepare budgets, prepare income tax returns, comply with federal and state payroll tax rules, submit sales tax, and distribute profits. Accounting methods. An accounting method is a set of rules used to determine when and how to report income and expenses in the business financial records and on how to report income and expenses in the business financial records and on business income tax returns. An accounting method must consistently match income and expenses in order to clearly show profit. The choice of an accounting method directly affects the profit figure for the year and the values reported in the ending balance sheet. For this reason, contractors should consult with an accountant before deciding which method to choose. While it is not necessary that all the details of the accounting system be known, it is necessary that the contractor understand which method will yield higher or lower profits or higher or lower assets in the financial statements. There are several methods for recording income and expenses in accounting. The cash method and the accrual method are the most common. Once an accounting method has been selected, it cannot be changed without written approval from the IRS. Cash method. With cash basis accounting, a company records a sale or income only after it receives payment from a customer, and it records expenses only after it actually pays its suppliers. That is, only when cash is paid out. The cash method is simple to use, but typically is the least accurate method with regard to giving an accurate picture of the company's real financial position. That is because expenses for a project may not be recognized in the same time period that the project's income was recognized. Accrual method. With accrual accounting, a company records a transaction not when payment has been made, but when services or goods have been delivered. The same rules apply when recording expenses. When a company receives a shipment of goods from its suppliers or enters into legal contracting to do so, it immediately records this as a transaction on its books. It is the most often used method of accounting for the construction industry. It provides a more accurate reflection of a business's financial position than the cash method, as it better matches revenues with the accompanying expenses. Percentage of completion method. Some construction jobs may take an extended period of time to complete. For example, it is not uncommon for a large construction firm to take 2 years to complete a job. If the company has only a few jobs in the process at any time and it recognizes revenue only upon the completion of each job, it may have a year in which no jobs are completed and no revenue is recognized, even though the year is one of heavy activity. As a result, construction firms may and do recognize income on a percentage of completion basis. For example, if a firm has paid out 40% of the estimated cost to complete a job, it may recognize 40% of the job's contract price as revenue. The accounting procedures for using this method will require good estimates, reliable and current information, and dependable method for determining the status of work in progress. The disadvantage of the percentage of completion basis method of accounting is that income, costs, expenses, and profits are estimated amounts. Completed contract method. To overcome the disadvantage of the percentage of completion basis method of accounting, recognizing income by the completed contract method provides the advantage of exactness. There are no estimates done since all income is recognized only when the job is 100% complete. However, this method is preferably only for small jobs with a short time span where payment can be made at one time. A framework of accounting practices has evolved over time for the construction industry, in that the contractor's accounting system focuses on each construction project. Each project and its related costs and income is accounted for separately from all others. As costs and income occur, they are accounted for directly or indirectly for each project. Then each project's account information is entered into a master account. Managing receivables. Receivables are monies owed to the business. Keeping up to date and accurate records of money owed to the company is essential for many reasons. These include ensuring adequate cash flow for business operation, providing accurate information to accountants or others who will analyze the status of the accounts receivable, watching the trend of invoice payments to the company to make sure they will fall within a reasonable collection period, accurate billing, which helps to maintain good customer relations and avoid disputes, accurate business planning, and growth by knowing how much money will be received by the company, preparing accurate tax returns, having accurate records available when needed for discussions, reference, and settling disputes, preparing for future contracts by knowing what financial resources will be available. Job costing. Job costing is a necessary activity for all contractors and should be a primary component of the accounting routine. In order to maximize income, a contractor needs to not only manage time, but also keep accurate records of the time spent on each project or for specific clients. In addition to time, direct expenses also need to be accounted for. For example, there might be delivery and pickup charges, extra materials, or additional work from subcontractors that had not been considered in the original plan. Under some contracts, a contractor might be able to recover these expenses from the client or owner. These records will enable the contractor to discover if the job resulted in a profit or a loss, and provide reliable information for future bids. Job costing system. How does it work? A typical system would start off by naming a job. A job can be a small or large. Each job is given a unique code by which it is identified. Jobs may be priced on a cost-plus basis or a fixed price quotation. Time spent on the job can be recorded either on a time card or directly into an automated barcoded system. There may be several different types of time and charge-out rates depending on who's doing the work. so each type of time is also given a code. In addition to time, any resources or materials used can be entered directly onto a job sheet list. The system can be set up using revenue and cost units. For example, a revenue unit for a drywall contractor would be boards hung or finished. A revenue unit for a paving contractor might be square foot of paving completed or tons of asphalt mix used. Cost units refer to the hours of labor or equipment and quantities of materials used. Contractors should give consideration to the coordination between their job costing codes and the coding that they use for estimating. It is beneficial to establish the bid estimate so that it parallels the job cost coding. This creates an easy and functional transition of the bid estimate to the working project budget. The CSI format is typically used as the foundation for both. See Chapter 7, Estimating and Bidding, for a discussion of the CSI format. At any point, a contractor can look at the total time and resources spent on a job, print out a job profitability report, or obtain breakdowns such as which employees have worked on a particular job. The goal is to devise a system that will help define costs and revenue in units as well as dollars. At some point, an invoice will need to be sent for the job, or an advance payment may need be received that needs to be recorded. To do this at any time requires the ability to bring an up-to-date list of unbilled work and materials used in order to create an invoice. Once the invoice has been created, these items will no longer be noted as unbilled and will not appear on future invoices. When the job is complete, a final invoice will be prepared. Break-even point. The break-even point in a business occurs when the total revenue equals total costs, and the business will then begin to realize a profit. When the contractor budgets for a job, both fixed and variable expenses must be considered. The fixed expenses are those expenses that would occur whether work is available or not. For example, mortgage payments, rent, utility bills, office personnel salaries, and benefits all must be paid even if construction work is not going on. When a job has reached its break-even, all fixed costs have been covered. Variable expenses, on the other hand, are those expenses that can be controlled by the amount of work that is projected to be accomplished. These expenses include construction payroll, overtime pay, supplies, subcontracting costs, and most general and administrative expenses. See Figure 6.2, Income Statement. It is important that the contractor understands the difference among these types of costs and correctly categorize each budgeted item. During the times when work may not be readily available, the contractor may choose to accept a job at break-even. While this action will not provide a profit for the company, it may enable the contractor to avoid eliminating employees, especially those who are most important to the company's operation. It also allows the contractor to maintain good, stable relationships with key subcontractors. Being able to recognize the relationship of variable costs to break-even budget will enable the contractor to avoid having the company lose money. Cash flow. Cash is the lifeblood of a business enterprise. Without cash, employees, suppliers, and other financial obligations such as loans cannot be paid. Inadequate cash flow is one of the major causes of failure for small construction firms. Both profit and cash flow must be managed. Cash flow represents the difference between the money received by the contractor for work performed and the expenses for overhead, subcontractors, etc. The cash flow can be positive or negative. A positive cash flow indicates that cash receipts are larger than cash outlays. A very important item is deciding what the firm's working capital requirements will be and ensuring that the cash will be available to pay bills as they come due. All receivables should be reviewed on a regular basis and collected when due. This means that as construction progresses, customers have been billed in a timely manner and payments due have been tracked and collected. If current assets cannot be converted to cash, other means of securing cash should be explored. The contractor must ensure that payments to employees and suppliers are made on time and supported by cash in the bank. Petty cash. A basic principle in controlling finances is that all payments be made by check. However, an exception is made for petty cash, used to pay for smaller items such as postage, express charges, and office supplies. When a petty cash fund is established, an estimate is made of future needs, usually for not more than a month. A check is drawn and debited to the petty cash account, and the check is cashed. One employee should be responsible for handling petty cash. The cash is usually kept in a lockbox, and anyone receiving money will sign a petty cash receipt. These receipts are used to balance the fund and to charge petty cash expenses to the proper expense account. The remaining cash plus the receipts should always be equal to the beginning amount in the petty cash fund. Bad debts. All businesses have some customers who do not pay their bills. This is an expense of selling on credit, and in some cases, these debts become uncollectible. Debts should be watched carefully so that they do not get out of control. A high percentage of bad debts is a sign that the contractor's procedures for granting credit to customers or for collecting accounts receivables need to be reviewed. Tax law requires a business to show clear-cut evidence that these customers will not pay the debt. Then the bad debt can be recorded against a specific customer's receivables and the amount written off. Methods to control the amount of bad debts should include a detailed analysis of each individual account, periodic up-to-date credit checks on customers, and having good relationships with customers. Financial statements. Many different people are interested in receiving and analyzing financial information about a business. They include managers, directors, customers, suppliers, owners, lenders, and financial groups. General purpose financial statements usually include the income statement, the balance sheet, and the statement of cash flow. These provide both detailed and summary information that is needed to assess the financial condition of the company. A small company's statements may be only a few pages long, whereas a medium or large company's financial statement may be lengthy. The company's management as a tool to make management and financial decisions uses financial statements. The accounting period will determine the length of time that is covered by the document. Monthly, quarterly, and yearly financial statements are used, depending on the decision of the specific business. The time period will depend on the need of the company to assess its finances and the financial health of the company. Proprietorships do not have to publicize financial statements, although they are often disclosed to lenders, bankers, investors, vendors, and other regulatory agencies. Public corporations are usually required to make financial statements available to shareholders and to the public. Examples of financial statements can be found in many business and financial books and magazines in bookstores and libraries. They can also be reviewed on the internet. Following are examples of two of the most important financial reports: the balance sheet and the income statement. The balance sheet is a snapshot showing the business at a point in time, usually the last day of the accounting period. This picture will change with the next transaction. The income statement gives a picture over a period of time. Both of these examples are simplified versions and are not necessarily representative of the typical numbers generated in the construction industry. However, the financial statements do provide a means for the company to examine and identify, with the help of the accountant, what areas can be improved to increase the profitability of the company. Balance sheet. The balance sheet is in Figure 6-1 on the following page, summarizes the assets owned by a company as well as the sources of its assets. These are divided into major categories of company assets and liabilities for the accounting period. A balance sheet lists all major assets such as cash, equipment, property, bank accounts, contracts, and anything else of value owned by or owed to the company. It also lists all liabilities such as debts, leases, rentals, overhead expenses, mortgage payments, and all else owned by the company. Finally, the balance sheet shows the owner's equity or net worth of the company. Three major elements provide basic balance sheet equation. Assets equals liabilities plus owner's equity. And here's an example, figure 6.1. Balance sheet, premium builders balance sheet, assets, total current assets 117, long-term assets, total assets 260, liabilities and owner's equity, total liabilities 74, total liabilities and owner equity 260. Income statement. The income statement in figure 6-2 summarizes the profit-making activities of the business over a specific period. The income statement might also be called the profit and loss statement or the statement of income and expense. A basic format of the income statement will show sales revenue or income, sales of product and services to customer, expenses, cost of products sold to customers, wages, benefits, occupancy costs, administrative costs, and income tax, and net profit or income, final profit after all expenses are deducted from sales revenue. Thank you for listening to Construction Business and Law Manual for Nevada, Chapter 6, Part 1. Please watch Chapter 6, Part 2. Thank you.